Another part of the preparation process is just, setting valuation expectations. Michael, can you talk about the setting of valuation expectations with your client at the onset of the engagement and just how important that is?
Yeah, so the last thing you want to do is have your client think the company is worth 50 million and you've told them it's worth 40 million. You were hired under that basis, and all of a sudden you find out that they're not going to do a transaction at 50. So what we do, and it's usually even before we're engaged, is give them a range of valuation. And what we do is we give them the range, and then we say, if these 5 things happen, the range is too high. And if these 5 things happen, the range is too low. And so they're getting a sense that this is not, there's some science behind this, but there's a lot of art behind this. And there's a lot of qualitative issues that go into it. And so when there's a surprise and we said, gee, we thought your recurring revenue was 90%, after due diligence, it's only 70%. That's going to be a huge impact on valuation. What do you want to do? And so we want to make sure that the last thing you want to do is go to market with a situation that the best scenario as possible is the only way to get a transaction done. That's a really bad way to go to market. So we're explaining value. We're explaining what the levers are in terms of moving, valuations up and down. But I think it's very important for us investment bankers to be the adults in the room and let them know what we think and why we think it, and get feedback as well. And the last thing we want is, to go out to the market and they have 3 shareholders and one wants to sell, one doesn't, and one's in the middle. We just wouldn't take that company on as a client in that situation. All the shareholders have to be in tune with not only valuation, but all the other issues that go on with a transaction.
Sure. Yeah, so Simon, there's price and valuation is one thing, but terms are another. At the onset of the engagement, do you also talk about, what the deal structure might look like, and get some buy-in, at the beginning of the sell side process?
Absolutely. In terms of it's a majority or minority sale, we've got to understand what the seller is looking for. But different buyers will take a different position over structure in terms of involving earn-out, involving deferred payments. And what we want to do is we tend to run a dual process, so we don't necessarily decide, we're running to a trade strategic or we're running to private equity. If a vendor just wants to sell and get best price, we'll go down both routes. And obviously the structures under a private equity deal could be very different from a trade buyer, strategic buyer, and what they're looking for. So we do talk them through the different structures, but for us, it's about maximizing overall value for the business, giving them options. And then at the stage where we get those on the table, we can then talk them through and present those different options to him and show him how under private equity, he'll get a second bite for the apple or cherry, depending on which way you want to look at it, or how you are going to be able to maximize and walk away with 100% from a trade strategic, albeit it may not be 100% on day one, it may be spread over a period of time. But certainly you've got to prepare them for that difference in structure that could come towards the end of the process.
Sure. Bill, can you add to your thoughts on value expectation and just deal structuring at the onset of the engagement?
Sure. The value expectation, I agree with my esteemed colleagues. Setting those expectations and being reasonable, working with a reasonable owner, executive is very, very important. I always say a business owner with reasonable expectations at a decent company, the odds of you getting a really good deal are really, really high. What happens is when they have irrational expectations or those expectations change, or they have some sort of issue or problem with the business all of a sudden, or they've withheld material facts, those things can obviously hurt. Running a process and getting multiple offers, it's always been very interesting to me running this, and I'm sure the other gentlemen on this panel have seen the same thing. You run a process and you get 3, 4, 5, 6, 7 offers, and you start seeing a trading band. Businesses or buyers that are completely different, there might be a little variation, but they're coming in at a trading band. And a business owner might have wanted 30, and you can say, look, we're getting offers that are 18, 20, 21. That's clearly, the market is clearly telling us something. As far as the deal structure, that is very, very important. We always push our clients, and I always recommend this, for them to sit down with their tax advisors, their financial advisors ahead of a sale and figure out what is the best tax advantaged structure for them to do a transaction. The key things, of course, always are we selling stock? Are we selling assets? They should also look at the accounts receivable. Is accounts receivable going to be taxed at a higher rate than the long-term capital gains? Because accounts receivable might be considered cash and taxed at the top marginal income rate. And also, is a non-compete involved in there? And is that part of the proceeds, the long-term capital gains, or is that suddenly going to be taxed at the income tax level? So a lot of those details we want to understand, and what's going to make sense for the seller so we can communicate that to the buyer and craft a deal that's going to make sense for both sides.
Mm-hmm. Regarding value expectations for me, I always tell my clients that the market's going to dictate what the value of the business is. But if I can't establish a value expectation at the onset that I believe I can achieve as an investment banker taking my clients up to market, it's likely that I won't take on that engagement because it's just not something that I can win. So that's kind of how I view setting value expectations, and deal structure follows that. Definitely provide my clients with kind of what my expectations on deal structure is. But again, market dictates what those might look like, and through the process, he tries to maximize it.
And just one bit of advice on one of the things that would be helpful when a company is thinking about selling is asking the investment banker, where do you think the valuation is in the last 5 transactions and where do you end up? And then tell me why it was lower, higher, or at the number. And they'll learn a lot from that question. And so, we have situations where we, almost doubled the value, and we have other situations that it was less than our estimate. But it would be interesting to hear the reasons why. And nothing wrong with asking to speak to those people as well directly to confirm that story. But they'll learn a lot from that question.
Yeah, we wouldn't necessarily turn away a mandate because of unreasonable expectations by the vendor. The way we would take it on, though, is we would skew our fee much more to retainers and a higher retainer than we would ordinarily on the transaction, because to us it's about risk and reward, and the risk is higher if we don't believe his expectation can be met. But if he wants to pay us to go out and test the market, then actually generally he will still transact on the best deal, but we would make sure that our downside is underpinned by that retainer fee.
That is a great point. And I've seen that done too in the market where, you'll balance retainer fees and certainty on engagement fees. As you mentioned, the assignment becomes more of a testing the market versus, going and kind of executing on what everybody feels is realistic. So, no, great point.